Welcome to our channel where we delve into the fascinating world of economy and finance. Today's burning question is, are the Feds done with rate increases? To answer this, we first need to understand the role of the Federal Reserve, often called the Fed. It serves as the central bank of the United States, wielding a significant power, the authority to set the federal funds rate. This rate is what banks charge each other for overnight loans. Why does this matter to you? Well, it directly impacts the borrowing costs for households, businesses, and governments. When the Fed adjusts this rate, it reverberates across the economy, influencing the returns on savings and investments. The primary aim of these adjustments is to stabilize inflation and maximize employment, creating a balance in the economic ecosystem. In a bid to combat inflation, the Fed has been on a rate-hiking journey, impacting the economy in numerous ways. Let's delve into the impact of these decisions. Since 2022, the Fed has been on a mission to combat rising inflation with rate increases. These rate hikes have had a profound impact on the economy and financial markets, and their effects can be seen in various sectors. On the bright side, the rate hikes have helped to temper inflation. From its 30-year high of 6.8% in October 2022, inflation fell to 4.2% in October 2023, marking the lowest level since April 2022. This is a significant achievement, and it can be attributed, at least in part, to the Fed's decision to increase rates. Moreover, the rate hikes have bolstered the value of the US dollar. This has a ripple effect on the economy, making imports cheaper and reducing the trade deficit. However, it's not all rosy. The rate hikes have also led to an increase in borrowing costs for consumers and businesses. This could potentially dampen spending and investment, slowing down economic growth. In addition, the rate hikes have exerted pressure on the stock market, leading to volatility and instability over recent months. This presents a risk for investors who may be uncertain about future market trends. With such significant impacts, the big question is, what's next for the Fed in December 2023? Predicting the Fed's next move isn't straightforward and depends on various factors. Let's delve into some of the key considerations that influence the Fed's decisions. Firstly, the Fed keeps a keen eye on the state of the economy, particularly the labor market and inflation. Despite the economy's solid growth, averaging 3.5% in the first 3 quarters of 2023, there are still some areas of concern. The labor market, for instance, despite having a low unemployment rate, is also showing signs of weaknesses, such as low labor force participation rate, a high number of long-term unemployed, and sluggish wage growth. Inflation is another key area of focus. Despite recent cooling, it remains above the Fed's 2% target, and there are potential risks of it rising again due to factors like increasing energy prices, higher tariffs, and stronger consumer demand. Secondly, the Fed pays close attention to financial conditions, including interest rates, exchange rates, and the stock market. Striking a balance is crucial here. If the Fed tightens monetary policy too much, the economy might experience a sharp slowdown or even a financial crisis. On the other hand, loosening monetary policy too much can fuel inflation or create asset bubbles. The Fed's goal is to maintain financial conditions that are stable and supportive of economic growth. Lastly, the Fed also takes into account the global situation, including developments in China, Europe, and other major economies. The spillover effects of its policy on the rest of the world can't be ignored. Global economic stability is a shared responsibility, and the Fed's decisions can have far-reaching implications. With all these factors in play, the question still stands: are the Feds done with rate increases? In conclusion, the Fed's decision on rate increases is a complex one, influenced by multiple factors. The state of the economy, financial conditions, and the global situation all play a crucial role. The Feds have to strike a delicate balance, aiming to stabilize inflation and maximize employment while avoiding economic slowdown or financial crisis. Their rate hikes have had significant impacts, both positive and negative, on the economy and financial markets. While we wait for the Fed's decision this December, we keep asking, are the Feds done with rate increases? Stay tuned to our channel for more updates on this and other economic trends.